Welcome to the show today, and good afternoon.
Thank you for having me, and good afternoon.
All right, Prof. The first question I'm going to ask you right now is that many economists are divided. A lot of opinions are coming up. But from your own understanding of the working of monetary policy by the current Dr. Yemi Cardoso-led CBN management, why did they retain 27.5% for the seventh times? 1, 2, 3, 4, 5, 6, 7. 7 times.
We could go on to 15 times. The fact of the matter is, there are fundamentals, and they are keeping their eyes on the ball. And there has to be a seismic shift for them to actually shift the position. Throughout last week, all the TV interviews I granted and newspapers said CBN should not be stampeded into dropping the rates because the fundamentals have not changed. Now, let's say there was a rebasing of the economy, of the inflation, and it looked like it came down from 33 or 4 to 22 or something like that. But that is a rebasing exercise. Even though generally the heat is going off inflation a little bit, but when you look at the month-to-month increase in inflation, there is a month-to-month increase. This is where you should focus your eyes, because for the food basket sub-index and then the CPI, composite price index, headline inflation, there was an increase on a month-to-month basis, even though compared to last year, there seemed to be a decrease in inflation to 22%, but that is not where you look, because they will be rebased. Those figures have been rebased. So forget what happened in 2024. Look at what happens month to month, because you've rebased the thing. You are comparing today's rebased figure to the one that was not rebased last year. So they can't be fooled. Secondly, there are also pressures on inflation from other quarters. Now look at Donald Trump. We don't even know what Donald Trump is doing. We all know that he gave us the 14% duty. Then he slammed another 10% because we are having a romance with BRICS, and he's now saying he's going to make it 50%. So we may be going from 14% to 24% and to 24 plus 50. 40 to, that becomes 75%. So you don't know where that piece of string, you don't know how long it's going to be. Then you have your main revenue that drives the foreign exchange arena, which is coming from oil and crude. Now we've been powering below, the price has been below. The benchmark is $75, but we're around 65, 68. We are running well behind the benchmark. And if you don't know what that means, it means that we are not having capital expenditures because we have a bloated accounting framework, a budgetary framework that is not going to, but it's going to strangulate capital expenditure. Because when you bloat it, you're doing three things. One, you are denying a headroom between what the benchmark is and what the real price ought to be. That difference normally will go to crude reserves. And then from that crude account, surplus account, then the money can have accretion to the foreign reserve. You've wiped that out completely because we bloated this account to be looking for $75 that won't come in the next 3 years. That is the projection. So, but then, of course, you also have the issue that, so when you come and look at this expenditure, the 2024 budget has been extended to December, which means, and what is actually extended is capital expenditure, because they are not spending on the capital. The first line charge is on debt service, which you know is now more 8% of our revenue. Then you have salaries of staff, you have pension, you have defense spending. Before you even come and say release capital for departments and then all these expenditure, capital expenditure, they don't get anything. So that's why they shifted that to December 2024 budget. We haven't even started touching the capital component of the 2025 budget. So now upon that, we are borrowing. We are going to borrow $22.5 billion, 15 trillion yen, and then 2.19 billion euro. All of these monies are coming in, and then the DMO is active during Eurobond and all that stuff. All these are coming. Where are they going? They are going to expenditure, public expenditure. and the middle name of public expenditure is inflation. We still haven't gotten through 33 trillion that was printed over that period because we securitized. So we have challenges. And so it's not a time when you say, oh, do this, do that. Central bank is not in that business of jump today the forward and then tomorrow it jumps back and all that stuff. That's not it. It has to be prudent in the way it looks at the data and then see significant movement shift in the macroeconomic parameters. Exactly. And I didn't see that. I look at the rebasing. The rebasing
Prof, I'm even coming to that. Prof, sorry, supporting you.
Exposed the rot in the economy.
Exactly.
When you have that has, even though it showed 41% increase compared to the 59% in the 2014 and all of that, they look at the figure for agriculture, 0.07%, which is almost zero. And a country that is growing their population at 2.83% and urbanization rate at 4.6% is having zero increase in growth on agriculture. And we can't see, people cannot see starvation staring at our face. And then we have a state of emergency, and people cannot see what that state of emergency means. Because we are not looking at the 230 million Nigerians that are hostage to all kinds of mitigated crises of food scarcity. So, and I cannot blame Tinubu for all of this, because that guy has courage, he has political sagacity, he's doing things that he had to do when he's convinced to do those. But who are his advisors that are advising him? When Obasanjo was there, Obasanjo said, I don't want advisors that I will be the one advising them, rather than them advising me. When Buhari came into office, Buhari didn't go to play a political game over infrastructure projects. He says, I don't want to know who owns these infrastructure projects. Just leave them. Everybody go back to site. And then he started doing the work. He started borrowing money to pay them. That is it. But what you have now is politicians politicizing important economic projects, PPP projects, and then you have large measure of, public crisis of interest. The interest overriding public interest, personal interest. So that is where these things need to be brought to the attention of the president, so that he can deal with some of the issues. If a minister doesn't want to work, move him to another ministry, or send him as an ambassador somewhere, or give him a post in the new political arrangement, so that he can open up the space, especially when it comes to food security. Any project that is supposed to deliver on food security should be re-examined and know where the bottleneck is. Where the conflict of interest and politicization of our food delivery system that is causing the problem.
Prof, so sorry to cut you in here. There's something that you have put our mind on now in terms of explaining some of the reasons why CBN have to take this decision. But one of such reasons you made mention is the rebasing of the GDP. And currently we have a GDP rebased at 372 trillion naira. Give us a perspective on this rebasing, because you have linked it up with the current situation that CBN have to put on the retention of the NPR at this point in time. But give us a perspective on this rebased GDP of 372 trillion naira at this point in time.
Now, the rebasing is done every 5 years. And why do you have to do rebasing? Is because some of the fundamentals, a change over time because of technology and innovation. They affect patterns of expenditure and consumption. So you have what they call industry standard, the international standard industry classification. That is what classifies different things, expenditure patterns. But then within them, when you look at them, to bring us to the points of best international practice, they notice that some of our activities are missing. For example, some variations of the digital economic activities, and you know how digital things like fintech, edtech, health tech, and envirotech is gone nuclear. Then you have activities like pensions fund administration. Pension fund is about 20 trillion naira. Then you have National Security Social Investment Trust Fund, NSITF. Then you have modular refineries, and also even the area of informal sector, and even domestic employers of labor, employing the cook, gardeners, and all of those, they have to be brought in. because these are informal sectors employment. And then even the value of informal sector contribution to the economy has moved from I think 41 to 42.7%. So it's all moving. So they have to reclassify. But as a result of those reclassification, based on when the one of 2014 was done, using a base year of 2010, and compared to 2100 or 20, when it was done, so there was an increase of 59%. Now, based on that 2010 and 2019, there's an increase of 41.1%.
Exactly.
So that is just on the and then that reflected on the GDP figures itself, because when you look at the GDP for 2020, there was a collapse because of COVID-19. So we went into minus 6.9% drop in the GDP. But from 2021, it picked up. It picked up to 213 trillion, then all the way to 2024, where it became 372 trillion, 0.8 trillion, which is about $243 billion. Right, so that is where we are, and the corresponding growth rates are about 3.38% for 2024 and all of those. So in effect, we now have a better reckoning on the GDP of 2024. It was effectively higher than what was presented. So where does that take us? That takes us to now know that we are working with international best practice. But when you now look at the first quarter of GDP calculation this year, which now sits on the new rebased economy, then you will see things that will make you want to cry. And I just said that one is agriculture. Yes, agriculture has moved previously from 22% of our GDP to 25% of the GDP. But the actual growth rate itself, this is as a result of rebasing, but the actual growth rate itself is 0.07%. And that is complete meltdown of our food security system. There's no other way to describe it. It's a complete meltdown. And then also another pathetic one is the industry. Industry has even come down from 27.6% to 21%. But then the growth rate is just about 3.42%, but it is not a good growth rate compared to what you will be expecting compared to our comparative nations. But what worries me is this. If your agriculture is 25% of your GDP, we expect industry to be marginally higher, to about 35%. Why? Because agriculture produces the raw material for industry. Two, the industry is not just about agriculture. You have solid mineral being processed is industry. You have crude and gas being processed is industry. Then you have other mechanical, metallurgical, all those other things like cam assembly and all of that. They are all still industry. So when you bring them together, it's up to be more than 35%. But that is not the case. And then both decent growth rate, because that's where we created. But what we have is still an import-dependent economy. And if you tell me to explain the tragedy in agriculture, let me give you one example. I'm involved in cassava value chain. Nigeria produces 71% of world yam production, which is 50 million metric tons of yam, and then 64 million metric tons of cassava, 20% of world cassava. But only 10% of that is available for industrial production. 90% is presumed to have been consumed. And then out of that, 40% are post-harvest losses. So you can see my nervousness and disgust for anybody that tries to tamper with any issue or PPP or any program that wants to lift Nigeria out of that abject poverty and production losses, especially in cassava and all of that. Anybody who wants to do something positive for this economy, you should frown at politicization of those and vested interest and private interest coming on the way. So that is the issue. And if you interrogate all the past ministers of agriculture of the past, they all have one problem in common. How can all these monies and hundreds of billions government pour into fertilizer, or how do they hit the ground, the last mile? And it is because of this problem of last mile that CBN of the past administration jumped into Uncle Bolowa's program targeting the base. So these problems have not gone away. And it is worse when politicians bring in politics into an existing scheme that is intended to help this country to produce more food. That is my angst about this.
Prof, I haven't said so much in that regard talking about the rebase, but let's get back to the CBN decision to retain the CPR and the NPR. For instance, there have been a third-party engagement by bank executives who argue, just like you have been alerting that politics in the agricultural sector, I think there's also a politics in the monetary sector where bank executives are now lobbying that the 50% cash reserve ratio should be reduced by Central Bank of Nigeria because they don't have enough to give out. So why would CBN also be asking them to keep so much with him or to keep so much with his Apex Bank and just have little to give out? So from your own understanding, this 50% CRR that CBN has asked bank to maintain, is it justifiable? And why should bank executive be asking that it should be reduced at this point in time?
Well, I have some sympathy for the CEOs because, as a matter of fact, since 2005, we have benefited over $200 billion in direct investment, foreign direct investment from the banks. But equally, we have also spent $6 trillion trying to stop them hemorrhaging them since 2008 when we have we paid our dues. As an economy, we paid our dues because we bought $6 trillion with AMCON to rescue the banks during the 2008 American subprime property crisis. They won't pay those monies, but they paid only about 1.5 trillion. But then they are surcharging themselves somehow and meeting us in our point. So the equation is balanced. But the thing is this: we needed to get a tight rein on the monetary parameters. So they should understand why central bank is tightening the news. It's not just the banks, but it's the government. Because the government, what we have here, we have monetary policy dominance over, fiscal dominance over monetary policy. And then one of them is that the bank has stopped giving ways and means. Because the law says you cannot give more than 10% of government's expenditure of the last previous year, and it must be repaid within the year. But that's not what happened. We shouldn't have allowed the central bank of last time to give more than 3 trillion. They gave 33. So it's many, many times more than the limit. And we are still waiting for them to repay. So all of those things, the bank is coming to terms with all of those. So unfortunately, the commercial banks are at the cold end of these measures. So I feel for them because they are doing their best in terms of prudential guidelines, and they are heavy. Because don't forget that the first duty of the central bank is financial system stability.
Exactly.
And the banks are heavy. Their capital adequacy ratios are heavy. 15%, 10 to 15%, depending on whether you're operating internationally or here. So all of that, and not performing loan 5%. So they're doing well. But so they needed more injection, or by way of reducing their exposure on CRR. And I think in the last administration, they tried to do differentiated cash reserve ratio, where they say, okay, because I want you to direct resources to the real sector, and particularly agriculture, we're going to allow you to borrow back some of those your reserves, your CRR reserve, and deliver on single digit interest with 1 year moratorium over 7 years, medium term borrowing, and focus on the reserve. So they did that, and it's still one way of central bank looking at the issue. And then secondly, the central bank should also get comfort from the fact that these banks are recapitalizing as they wanted them to do. And a lot of them are going to hit the bottom because they're all getting very close to their target.
Exactly. Now, Prof,
of course, that raises other issues.
Exactly. Now, before I let you go, there's one very interesting aspect of the Nigerian economy that many of us economists and policy analysts have really cheered the federal government for. The first quarter GDP shows that the service sector have really shown the leading light. From your own perspective, how did the service sector be able to meet up and be able to show us the leading light in the first quarter of 2025?
No, they've always done. They've always done since the liberalization. Because who are the ones delivering on the service sector, on the service? You have the ICT. ICT leads. Not only that, ICT has 6.78% of the GDP, but they deliver almost 10% growth rate. Banking and finance, even though banking and finance is about 5% of the GDP, but they deliver 33%, 32% growth rate. They do very high growth rates. And you know, ICT underpins not only the digital economy, but also the financial services sector. So it is a very, very dynamic relationship between the two. The other ones are trade. You know, and then we're a trader nation. That's why we're import dependent. So they're always buying and selling. And if you go and look at the loan books of microfinance banks and these commercial banks that are lending, which is one of the reasons why CBN is on their neck, they lend, tell me who can borrow 30-something% interest, 34, 32. It's only traders who can do that. And these traders are importers. They want them for 3 months. They import their goods and pay that, and they are able to pay back because they can have a complete pass-through of the imported inflation. You can't give it. Manufacturers are not going for that kind of money because they can't pay it. They can't survive. So this is the point. So when you like to understand where the money is pouring into, and then of course the banks also make money from foreign exchange transactions.
Exactly.
And then the central bank came and closed their net open position on foreign currency to 20%. So that they can release more of their liquidity to the system.
Exactly.
So it is a balance there. I have been advising central bank to look at this case where if you add up all the proceeds of the recapitalization, it will come to $3.3 billion.
Exactly.
So what I say to CBN is allow some of the tier 1 banks that can go to 1 trillion instead of 500, or who can even go to $1 billion. Because if we allow them, then the total capitalization can actually rise from 3.3 billion to $10 billion. But what you do, it incentivizes them to say, okay, if you voluntarily go to this limit to $1 billion, I will give you 200 million naira of our foreign reserve to manage. Maybe not the $500 that was given to them in 2005, but you can sell $200 million or something just to encourage them. And then also, some of them will be worried that you are going to seize a head of their assets without giving them money. So you may also now look at how you may also bring in the differentiated cash reserve ratio in a way that the limit is less risky. So some of those will bring more access, because what happens is that you are now going to have mega banks in Nigeria that are global in their operation because they are heavily capitalized. They are capitalized with over $1 billion. And then they have to do that because our fintechs, we have the unicorns. We have over 6 unicorns, that are already $1 billion or more. Fintechs that are, homegrown companies. If they are doing that and their money point is going and buying up banks in Kenya and all that places, our banks should follow through. That's the point. And then if you want big size loans, then these banks can do it, because at the moment, if all their capitalization is going to be 3.3 billion, if federal government wants to borrow 5 billion for any project, all of them will have to come in and throw their money in for them to have a big project because of their single obligor limit. But if you allow them to go up, 2 banks can come together and form major infrastructure. That's the point that I'm trying to raise.
Exactly. Prof, before I let you go, I'm tempted to ask you this question. Many have also cheered and have praised that the Dr. Yemi Cardoso led CBN management have done a very good work by retaining the MPR rate. Reason being that the gains of the Naira will be stabilized more and Naira will be strengthened more with this retention of the rate. What's your perspective on it, sir?
No, see, one of the things you haven't talked about, when we had the rebasing, what it did was it made us less conscious about negative real interest rates. Because negative real interest rate is when the interest rate is running behind inflation.
Exactly.
It means that a negative real interest. So who is going to invest in your economy? You put 1 million and then you expect to collect 23 million. 23%, and then the inflation in that 1 year is 30-something%. So nobody's interested. Do you understand? So, but now for it to now come down below the base rate, when I have base rate at 27.5 and inflation is low, there's a positive real interest rate. But the second point is this: it's a dangerous thing to tamper with MPR rates because that they drive they affect the rates at which bond yields and all of that. And then that's the only thing that is attracting foreign portfolio investors. The FDI is a complete meltdown. So the foreign portfolio investors will borrow money from foreign constituencies at 3% or 4%, and then given that the money is going to be stable, they can invest it immediately and buy some euro bonds here or buy some treasury bill that has government guarantee, sovereign guarantee, and then after 6 months or 1 year they can cash out. And because you have kept the state rate, you see, they can cash out. So you have that inflow in and out, because you are maintaining a steady currency regime. So you don't want to scare them away, but suddenly start dropping rates, and then you get them scampering for safety, running back to America. Because it's one of the considerations.
Very interesting. Prof, I will hold you for an invitation for us to talk about recapitalization of banks in Nigeria. It is quite interesting that we need to take that up with you in future engagement on the show. But thank you so much for coming on the show today.
Thank you for having me.